Yo, yo, yo. Good afternoon, good morning, wherever you are in the world. Mad love and respect for passing through to the Traders Reality channel. I just want to welcome all the new guys who are rolling through. First things first, uncomplication. Mad love and respect for you, my brother, for shouting us out in your channel. You know what? I've never spoken to you before, my friend, okay? And this is how much of a wholesome person you are, bro. You know, you didn't have to do that. And thank you very much for saying those kind words about the Traders Reality system, the challenge that we both have to try and get and guide people into the right direction when it comes to cryptocurrency, or more so the game of trading. So thank you very much, my brother. Mad love to you. But ladies and gentlemen, I'm here to talk about something, and I'm going to break down what on earth Bitcoin is doing right now. Okay? The thing that you must be aware of, guys, is this. Yesterday's big hype, the big game, did nothing for crypto, in my opinion. Price stalled. Okay? But we will see the result of that in probably a few days, maybe a few weeks' time. Okay? You can't spend that much money on marketing and not get anything back from it. But although that's what marketing's about, you can spend as much money as you want and there's no guarantee that you'll get an end result. Okay? Quite clever tactics by the crypto players in the field of crypto. Have done a very good job of getting people's attention. Okay? Now we're going to see the proof of the pudding based on what happens with Bitcoin. And why is it going to be Bitcoin? Because to the new person coming into crypto, the first thing they're going to be looking at is Bitcoin, because that's what every single exchange, any app is moving forward with. Everyone wants to know what Bitcoin's going to do next. How do I buy Bitcoin? Do you think they're going to start buying COTI or ADA or XRP when someone steps into cryptocurrency? No, which is why you hear me say Bitcoin is and always will be the fashionable coin. It will be the basis of cryptocurrency. It's timeless, okay? Anyone new to cryptocurrency will say, do you have Bitcoin? What is Bitcoin? How do you do it? How do you buy it? Can I hold it? Can I pick it up from somewhere? You know? You see what I'm saying? It's all going to be Bitcoin. In this channel, we've been looking at this play with Bitcoin, trying to establish what is likely to happen. Now, it's probably being said across the board right now that Bitcoin is on its route to make a massive move to the upside because there is something happened a couple of years ago, or it's in the same place. We've seen this similar behavior before, so that means it's going to happen. No. Unfortunately, ladies and gentlemen, that's not how the business works. Because if it was that simple to assume that Bitcoin was going to bounce from one zone against the next because they did it last time, well, let's just go back in time and have a look at this area right here. There were loads of hype about the September the 29th, when Bitcoin moved away and made its all-time high, and people were fixated on the idea that this is where Bitcoin's going to bounce away from and it's going to move back up to test the all-time high, 100K. Ladies and gentlemen, get the popcorn out. Bitcoin's on its way to make a move. Urgent, emergency, warning. What on earth is that? Well, look what happened. They did a good job of making people believe that. And then they just simply bled price to the downside. So even though people were paying attention to this zone right here, they had accumulated enough orders in this area based on people buying the dip. Go back into 24th of December, even in this monthly period in the channel, all you will hear me saying is please, please be careful. Do not buy the dip. Do not bottom fish. You're going to get caught out. And all the guys that may have brought the dip were seeing a little bit of success, but we were waiting in this channel for the test of the 800 EMA. You see, if Bitcoin can't close above the 800 EMA on the 1 hour time frame, I ain't interested in looking for any longs. And it did just that. It came up above the 800. People placed their orders above it. They got triggered. Happy days. The market maker fulfilled the obligation of the guys who wanted to see price move higher. So they got their longs filled. Stop hunt rise, drop. Stop hunt rise, collapse. Because the narrative was that people would be thinking that Bitcoin was going to make the same move from here to the upside. See, this is the thing about the cryptocurrency space. There are many people that have been involved in the game of crypto, but I believe there are only a handful of people that understand the concept of what trading is. Trading in the past, okay, is no indication that it's going to happen again. Now, the cliche thing to that and the great paradigm behind all of that is this. We seem to see the same thing happening over and over again. So can you blame people for thinking that if price comes back into this area here and then it comes right here and then you would anticipate because it's actually higher than what this zone was, it's going to move away from that point? You can't blame people for thinking that narrative. Why? Because we're in the game of the unknown. This is the game of uncertainty, ladies and gentlemen. We just don't know. All we can do is measure our element of risk. How much money are we prepared to put at stake to say we are correct, and or how much are we prepared to lose if we are wrong? That's what we're doing. We are about committing liquidity in key points in the chart where we believe it's going to go higher. And how much money are you going to pay yourself if it goes in your favor? Or how much money are you going to be charged for being wrong? You can be charged as much as you want, ladies and gentlemen. I know I have been in the past. I never knew what the idea of closing a trade meant. I just saw it as just keep putting money in it and close it until it's in a profit. Yeah, well, you see, the market maker's liquidity tends to be a little bit more than the average retail trader. Okay, he can be irrational. You can't. Which is why you have to have risk parameters. You have to get comfortable with understanding that you can lose in this game. But you can also win if you understand what they're trying to do. Because the market maker can only spend so much time in a particular zone before he needs to come away from it. Why? Because the market maker's business model is to fulfill the obligation by the retail trader who brings liquidity into this marketplace in form of orders, shorts or longs, buys or sells. And the market maker, in order to fulfill the idea of a fair marketplace in the sense where a smooth, continuous flow of transactions, he needs to fulfill those obligations. So when you buy, the market maker sells. When you buy, he sells. Why? Because your position to favor higher prices is matched with a position to favor lower prices. Yet you see, the market maker can afford to be in a losing position for as long as he needs it to be until he decides to turn price back to the downside to favor his position. Why? Because the retail trader doesn't know when to close. Which is why you see price as, for example, like so. Look at this. Look at this range. Price is dropping to the downside. Market maker has made people believe it's going to drop. So retail traders sell. Now you can only sell if someone buys. So the market maker keeps on buying and buying and buying and buying until the point that he has got enough liquidity trapped in this area here for him to come back and realize a return on his longs. Why? Because the liquidation points that retail traders come to the game with, in other words, they use leverage. Every time you open a trade in Bitcoin with leverage, you are committing a certain amount of money as margin. Those margins are visible in the chart to the market maker, okay? Because he has to match your liquidity when you come to placing an order, you see? Because when you see a profit in your trade, you're taking away his money. When you close your trade at a loss, he's taking your money, all right? And just look at the pattern. You can see they've moved price down. They stabilize, get the retail trader with the belief it's still going to go down lower, mark price down lower, commit liquidity. Market makers going long, going long, going long, and then he shifts out of the range and comes back to the last zone that he started building his trades from. Okay? So if you look, you can see the red vector candle range, they recover it. The red vector candle range, they recover it. Now, just to simply say, go in the chart and look for these red candles and wait until price hits them, you could say that could be a bit of a good strategy. But what if you end up waiting in this area here and then you end up closing your trade as it starts to drop to the downside because you've had enough sitting and waiting for them to come back to the red candlestick right here? You would have closed at the wrong time. which is why we have patterns. These patterns are psychological patterns. They are not so much static patterns in the sense where once you see them, you have to trade them. No. This is a psychological pattern in the sense where the market maker is going to lure traders into the belief that something is happening against something else. It's an equilibrium. Make retail traders believe prices dropping to the downside. That's your first leg of the W formation. They bring it back up into the fray. When they bring it back into the fray or to the median, okay, by moving price back up, they are hitting traders' liquidation points. Well, let's go to the high block. The high block shows that. Every time you see price moving up, he's taking liquidation points for the short sellers. Now, we got a lot of short liquidations to the upside, ladies and gentlemen, and it would be wrong to assume that we aren't going to come back up to hit these liquidation points because you can see what they did with these longs liquidations from last week. Okay, here we go. Here's the same chart. Can you see it? It's funny, isn't it? We've got the opposite now. We've got more long liquidations from last week. Now look what's happened. They've come and eaten that range. Okay? Now we've got liquidations for the shorts. Are we going to come back up? Maybe. But we need to use the structure of price action. What's the market maker trying to make the retail trader think? Okay? How long is he going to spend marking price from one point to the next to get you, the new guy coming into cryptocurrency, to believe that price is going to the upside? Quite frankly, ladies and gentlemen, I do my hardest to avoid the news. Why? Because anyone talks anything about Bitcoin, the information has already been absorbed in price action. See, that's the thing. People will hear the news and say, did they just say that about Bitcoin? Quickly go and buy it. No. They release that information because they need you to step in to buy it so you can buy their contract that they're trying to sell. You can't buy if no one sells. You think that when Tesla declared that they were buying cryptocurrency, you think that big pump to the upside wasn't already premeditated, that the market didn't have the orders already set? You see, the market maker works like this. Before price gets into a particular point in the chart, they have already got the algorithm set to place orders and trigger these orders. Because remember, the market maker needs to make sure that there is an ebb and flow in the marketplace. So he's got orders down here. He's got orders up here. Wherever he decides that he wants to try and hit first based on the liquidity that is present, because market makers don't care about your time in crypto. They don't care if you've got 50,000 Bitcoin. They don't care at all. They want to know if you're going to put it in this chart right in front of you by a means of an order, because when they see your little order come through, whether you have, for example, you trade with a $10,000 account, it's liquidity to them. You got $1 million account, it's liquidity to them. Is it much? No. Not to the market maker. Yeah? Because you've got to remember, even if a whale is stepping in and trading leverage, okay, whatever liquidity he's using, he's only using because it can be matched. So who really is moving the markets? You think whales are moving the markets? No, they're not moving the markets. The coin aspect of Bitcoin is different. This is leverage trading we're talking about. If a whale goes and buys 50,000 Bitcoins, all right, that can be a very interesting thing. Naturally, you would assume that price is going to do something, okay? But then when you come to the chart, it doesn't do anything, and it always ends up going in the opposite direction. Why? Because when someone buys 50,000 Bitcoin, it kind of makes the news a little bit, and people will rush to buy, okay? But when price is dropping, okay, after that sort of news, well, they've already factored in the purchase and now they're getting rid of it. Okay? So they mark price down lower because people are coming in to buy it or sell it because they have the belief that people could be buying. There's a big order coming through. Bitcoin's being brought. Quickly, I can sell my Bitcoin at this or I can buy my Bitcoin at that. What I'm trying to say to you, ladies and gentlemen, is the game itself is not as simple as someone said something on the internet, that's going to be a result of it in price. No way. All it is, guys, is who's committing liquidity at this point in time in the chart, which if you are still struggling with what I'm trying to say to you in the channel, there is a playlist, okay, called Understanding the Hybrid System, okay? And there are key aspects in that playlist which will show you how I understand the utility of the moving averages, the times, the sessions, the candlesticks. Go through that and check it out, okay? Cool. Now, on the basis of Bitcoin right now, because we are actually talking about this pattern right here, okay, as a psychological pattern, traders are in the impression right now that Bitcoin is going to bounce and move away from this zone, okay? But looking at the price action itself, there is a little bit of a cause for concern, right? If Bitcoin's going to move up right now, all right, where's he likely to move it to, okay? So I have to look on the chart and say, well, where was the last time someone brought? That's one place. That's another place. That's another place. And then we've got this at the upside right there. This is where they're buying. That's the retail trader. But at the same time, this is where the market maker could be, marking up his shorts. Remember, he goes short when you go long. So as much as Bitcoin is holding at the 800 EMA on the hourly, it has crossed over. And this is what we've been waiting for Bitcoin to do. Because when they broke above this, I said on the 5th of February, 4th of February, we need a clean test of the 800 EMA. And here we are. Bitcoin is holding in and around its psychological ranges. Look at the importance of that. They are building positions in this zone. Now, if we go to Forex, sorry, this is so bright. The news, okay, is sort of, here we go. Russia Lambrov says we can see a way to move forward with talks. Great. Okay. That's happy days. So things are starting to look good in terms of tensions across the board. All right. Now we've got this thing about the Fed. Are they going to start, executing hikes in March? What's the story there? So these are really the two things that are actually keeping Bitcoin, or more so traders, committing to maybe safer investments. So let's look at gold for example. Gold's moving up. Okay. Gold is moving up. People are scared. They are committing liquidity in safer havens because they are anticipating that something is going to happen where people will need to seek safety in terms of diversifying their portfolios. Look at the yields. Okay. The yields have actually moved up ever so slightly, but narratively they are coming down because people are starting to look to favor safer options with government bonds. But here's something funny. Look at this. Look at Bitcoin's 1 hour time frame. This is the 30-second. Bitcoin's 1 hour time frame formation right there. And look at the yields. Funny, isn't it, ladies and gentlemen? This is a classic example of understanding psychology of people's trades and where they're likely to put them and take them from. You see, the idea behind the yields is when the government wants to advertise a great rate of giving them your cash, okay, price rises. It's 2%, hit above 2%. And everyone's like, whoa, government yields rising, cool. That means people aren't giving their money to the government in form of bonds. But when it's dropping, it means they're rushing to the government for safety because they've got these billions of dollars worth of portfolios. And the 10-year yield is really the only place that they can actually push those to minimize their exposure, okay, in times of uncertainty. But isn't it funny how the yields itself is looking exactly the same as what Bitcoin's doing? Why? What's the story there? Could we assume that based on what's going on with the equities, if Bitcoin's got a coefficient with the equities, a positive coefficient with equities, then the yields themselves are a reflection of people taking their money in and out of equities and rushing to government, rushing for safety, rushing to gold. Okay? Do you see where I'm going with this? Could we use the treasury yields, could we use the yields to understand if people are going to put their money into Bitcoin or they're going to seek safety? Because when dollar rises, Bitcoin usually rises. And that's the disparity we saw only a few days ago, last week, sorry. But just look at what's going on with Bitcoin and look at the yields themselves. The yields will give you the trader's psychology. What's their mindset? Are they feeling optimistic about the economy? Are they yes or no? Because Bitcoin is still an asset that you can exploit your portfolio to and get to take advantage of volatility. This could be oxygen. It wouldn't matter. At the end of the day, if traders aren't coming to platforms to invest in risk on assets, it's going to be shown by the yields, and it's also going to be shown by the utility of gold itself, and gold is rising. So where does that leave you, ladies and gentlemen? We'll put it like this. If we are in a cyclical move to the upside still, Bitcoin by principle will be moving higher to take out all these previous areas of longs that people have tried to go long from, and of course take out the liquidation points for the shorts, because right now, with this small move to the upside that you've seen Bitcoin do just here, they have taken out a lot of short liquidations, okay? And those are all 50x. As you can see, the jade-looking color right here, green, yeah? They are hitting the liquidation points. If you zoom in and look closer, you will see it. Forgive me that this screen is so bright. You can see where the green lines end up is where there are live liquidation points, traders in margin. Where they were and where they are disappearing means that they have absorbed those liquidations. Traders are going long here, going long, going long, going long. If we look down in the visible range, you can see there's $15 billion worth of short liquidations in the visible range. Okay, now $15 billion sounds a lot to the average person, but to the market maker, it's what we would see as $15, in my opinion. Okay. So looking for a move in Bitcoin, you have to establish where you think Bitcoin's going to go next. In other words, are you a swing trader or are you a scalper? That's what you need to try and get into your minds. Because if you're going to come to trading with the idea of a scalper's mindset and try and look for a swing trade because everyone's talking about Bitcoin moving to the upside, then ladies and gentlemen, you're going to get burnt out. So this is what I suggest you do. Okay. Keep an eye out on this range with Bitcoin right now. We are expecting that Bitcoin is in a cyclical move to the upside. So we are anticipating one more move up. The concentration of that move is going to be really important as well, because this is on the 1 hour time frame, guys. I'm talking in terms of day trading. All right. I'm not interested in Bitcoin going to 100K from here. No relevance to me. All right. I'm looking at where I can, in essence, improve the chances of a trade playing out based on the visible range that I can see liquidity available for the market maker to take. So if we look here, we can see up here, there's $13 million worth of longs, of short liquidations there. We've got, as you move up, if we move out from this area here, you'll be able to see in a second. I'll go back to that in a sec. Usually takes a little while. Come on, man. Takes forever. All right, forget that. We'll look at this chart. Look left and you can see the vector candles, the red ranges. Now, these red vector candles imply that there's liquidity in that area. It's made up of liquidations for the shorts, okay? And it's also made up of the market maker's positions that he had gone long from. Because remember, you can only sell if someone buys. And his positions are there. And he will be triggering those orders and activating profits by releasing the trader's short liquidations and triggering his orders to move price high to get shorts. Remember, he has to buy when you sell. He has to sell when you buy. And he does that in a sequence whilst price moves in either direction. He buys and sells as it's going up and he buys and sells as it's going down. But what he's doing is he's tapping into liquidity that traders are committing into the charts. See, he can't take the liquidity that he has given the retail trader. So remember, retail trader, market maker. Retail trader goes long. Market maker pings him back the same order as a short, okay? Because he's providing the liquidity for it. But when the retail trader goes long, the market maker can see his money is here. That's where he sees it. Market maker has nothing to do with this right here. This is what he's drawn to. He's drawn to the liquidity below the retail trader who's long in 100x, all right? He can see his liquidation points are here. So what's the market maker going to do to make sure that he can get price into that area as soon as possible? All right? By means of stops, stop hunts, spike, shift out. Okay? Because when he hits the stops to the downside whilst people are in a long, the retail trader is going to do what? He's going to add to his margin and try and move his position lower and lower and lower. All right. Then the market will then bounce away from that point and continue to go higher. Retail trader thinks, yeah, man, I've caught the stop. I'm ready. It's going to do the reversal. I'm going to add more to my position and buy more. So that retail trader right here who went long in this area is now going long up here. Okay. Now his margin for his liquidations for his longs, they have gone from this area here. Now they've narrowly moved up a little bit. So now the market maker has put the retail trader in the same position as he was earlier on, but he's made him commit more liquidity. And it's at this point where the market maker will keep price in a particular point. He will spike the range to the upside. The retail trader's confidence in his trading is at its highest. It can never go wrong. And then he comes down, pulls it, and then makes the retail trader think, okay, it's pulling back. I'm going to add more to the position because I want to buy the dip. This same position that he was keeping an eye on now has now actually moved up even higher because the retail trader has now committed more money to opening more positions. He's now reduced the amount of liquidity he can put into his margin to protect his trade. Okay. Market maker now has got him committed to moving closer and closer to the point where he's going to get ready to spike price. And then before you know it, bang, he drops price to the downside, triggers the liquidation point, and Mr. Retail Trader, who had many attempts to pay himself, is now scratching his head thinking, what on earth has just happened? The market is out to get me. I'm going to quit trading. And here, ladies and gentlemen, is a classic example of that. Stop hunt low, rise, brings it back down, makes the retail trader think it's actually coming in to buy the dip. Price is rising, and then with aggression, they come into this range and spike down lower and shift it back up again. Ladies and gentlemen, that is how price works. Have you heard me talk about any indicators? Have you heard me talking about any Fibonacci's? Have you heard me talk about any MACDs, any RSIs, okay? Any bull flags, bear flags, Toblerones, you name it. I might have a little stab at it, guys, but what I'm trying to get across to you is you didn't need that information to understand the flow of liquidity by simply paying attention to traders' sentiment in how they behave when price is moving up and when it's moving down. Why do we seem to have the same idea about the average retail trader? Because everyone is a retail trader. We all have this behavior. I used to have the same behavior, ladies and gentlemen. I wasn't born a trader. No way. I became one. Because I understood the nature of the game by taking in two schools of thought and merging them together and trying to apply the understanding of what these schools were about. Okay? That's what this is all about, guys. It's understanding when are they likely to move from one zone to the next based on the commitment of retail traders' liquidity. Right now, there is $15 billion worth of shorts in the range between 47 and, of course, the 41 area. 47 and 41. This is where it's at, ladies and gentlemen. That's our range. Mark off in the chart that range and then 41 itself and pay attention to what price does in that range. Can you see it building shorts or are they building longs? What do you think they're doing more of and not following through with it? Are they building shorts? Let's have a look. Look at the key 44,000 zone. They keep spiking above that range and coming straight back down. Come up, come up, come up, and then they pull it back down again. Okay? Why are they building and doing this with price? Why are they spiking up? If they want to move price higher, why are we seeing these influxes of green vector candles or big pushes up? Or as the retail trader would say, bullish engulfing patterns. They would see this candlestick right here and think, oh my God, man, look at that. It's just engulfed all of those candles. That is great strength. Yep, they pull it all the way back down again. Traders are trapped. Look at this candlestick right here. Big red vector candle to the downside. They committed traders into believing now this is Bitcoin's top. It's going to drop down to 20K. Oh my goodness, Bitcoin's going to crash. They spiked lower, got them committed to the trade, and then they reversed it back up. See, when you have that understanding in the back of your mind, you're not going to be the trader that goes in blindly and takes trades just because you see a candlestick showing this behavior. You see, the guys in this channel, when they see a big green candlestick, my guys are getting ready to go short. And I can guarantee 90% of retail traders across the board are going long, because in order for them to go long, the market maker has to provide them that liquidity, and then he allows them to see a little bit of success before he then starts to pull it back. So, ladies and gentlemen, I've had you here for the past 29 minutes. Mad love and respect, and I hope that anybody that is new to the channel, and if you've made it all the way through to the end of this video, okay, please comment below and say, I survived. Yeah? Please say that you survived this barrage of ear-battering attempts by me to get this idea across to you on where we think Bitcoin is going to go next. because we don't want to just think, yeah, it's going up or it's going down. We need to understand, what are they developing? If we are coming away from this cyclical pattern to the upside, we naturally would assume that they're going to come up higher and take out these zones to achieve a level 3 move to the upside. Okay, which we would naturally assume that Bitcoin is going to formulate an M formation up here and then look to try and come back down. But the problem that we've got, guys, is Bitcoin right now is in this range right here, and we've got this liquidity right here, and we've got these liquidity zones right here. Which is it going to be? The only way we can really truly work out if it's going to go in either direction is we need to pay attention to what New York does today. So, ladies and gentlemen, proceed with caution. It is 20 past 1. Sorry, it's 20 past 2. All right. New York itself is fully open and we ain't getting the activity that we are anticipating. Okay. So just please proceed with caution. Mad love and respect to every single one of you people. Have yourselves a wonderful day. And I will catch up with you in tomorrow afternoon's stream in the New York session at 2 p.m. Take care of yourselves, gang. Peace.